Welcome everyone to our course of international business. So, in the last lecture we were discussing about balance of payment, what balance of payment is and what are its components. So, we discussed about the major components like the capital account, the financial account, right, current account, and then we discussed on how balance of payment of a country gives an idea about its economic position, right. So, whether it is in a surplus or it is in a deficit, and how the balance of payment has to always match, it has to be a balanced account, right, like any balance sheet, both the debit and the credit side has to be balanced. So, from there today we will talk on another very important issue which has a very large influence on the world finance and the financial markets is foreign exchange, right. Recently you must have come across a company called Cox and Kings, which has been on the verge of close down in India, right. It is basically nothing more than a travel agent. It was a travel agent, but why I am saying they were basically foreign exchange regulators. So, they help you in currency exchange when you go from one country to another. So, for example, we have Thomas Cook, Cox and Kings, right. So, these are some examples. So, what is foreign exchange? When you understand the word foreign exchange is when you have to go outside to another country, maybe on a tourist visit or a educational trip or something, you need some currencies of another country, right. So, when you so how do you do that? You give your own currency, you have maybe an Indian rupee, and in exchange you take a dollar or some other currency which is particularly from that country. So, suppose you are going to some European countries, you need euros, you may need pounds, so you need dollars. So, basically it happens that sometimes the dollar is one currency which is maybe used in almost most of the countries, right. So, it has a very high applicability. So, what is this foreign exchange and why do we need it and how it impacts businesses across the world. So, today that is our major discussion. So, what is foreign exchange? As it says, as you can see this diagram. So, there is something like somebody is giving Indian denominations of 2000 rupees, and in exchange they are taking the dollars, 100 rupees dollars, right. So, as I said, when I am going to let us say to attend a conference abroad, so I need dollars. So, whichever country I am going, suppose I am going to even Turkey or I am going to Canada or I am going to any country, I can take a few of the local denominations of that particular currency of that country, and maybe a few amount I can keep in dollars, because dollars is used everywhere across the world, right. So, what is this foreign currency, foreign exchange? Foreign exchange is the process of trading of one currency for another or system of converting one national currency into another. So, for example, as I said, rupee for dollar, right. So, or some one currency against the other, right, dollar versus euro, right. So, euro dollar. So, all these things when you are converting or exchanging, it is termed as foreign exchange. It also involves trading one currency for another, right. An exchange rate. So, how do you determine, how do you exchange the currency, right? It is not that you give 1 rupee note and you get $1. So, there has to be some equivalence. So, this equivalence is known as the exchange rate, right. So, this exchange rate is the price of a currency or value of one currency in relation to the other. So, that means, for example, as of today, the Indian rupees 1 US dollar is equal to today November in the month of November 22nd, 23rd, it is 71.19 rupees is equal to 1 US dollar. So, suppose you need let us say 100 US dollars, that means you need 100 US dollars, you have to pay out 7119 rupees, right. So, that is what it says. The most popular in the world is the US dollar, followed by the euro. There are in dollar also, there are several dollars, for example, the US, the Australian, the Canadian, but we are talking about here the US dollar, which is the most popular, followed by the euro, right. So, as it says, for example, how many Indian rupees does it take to buy 1 US dollar? as of December 24, 2019, the exchange rate is 71.19, meaning it takes rupees 71.19 to buy 1 US dollar, right. So, this is the basic meaning. So, as you can understand, this will have an effect on two important points. One, this exchange has an impact on people like me or individuals, or this is called retail market, right, and where it is on an organizational basis, right. So, where large organizations trying to import some items, so they have to pay, right. So, they have to pay in dollars. So, in such conditions, when you are trying to make any transaction, make any business, so the organizations have to pay or buy whatever they are getting money, or they are giving money, the currency is the dollar. So, at that time also they would require a exchange, right. So, according to the currency of that particular country, they would have to make the exchange. So, what is this foreign exchange market then? So, as you see, you can see this table, right, this diagram. So, this is like US dollar, euro. So, there is some like this, looks like a kind of a chart, right. So, it says a market in which the national currencies are bought and sold against one another. Some foreign exchange markets are, for example, Mumbai, London, New York, Tokyo, Zurich, Frankfurt, right. So, these are some of the major locations. Exactly, it is not that there is a place, right. The foreign exchange market happens over the counter, it is an OTC, right. So, as it is written over here. So, it is a non-localized market which exists in the network of an information system. So, the business is done through telephone, maybe internet today has come up, and the foreign exchange markets have grown tremendously. So, all this thing works on the information system, right. So, the foreign exchange market is one of the largest and the most liquid markets in the world. In fact, when you talk about financial markets, nothing can be considered more bigger than the foreign exchange market. It is dominated by the US dollar, the euro, the Japanese yen, and the British pound, right. According to the Bank for International Settlements report of 2016, the foreign exchange market cap averaged 5.1 trillion per day, that is in 2016. But if you look at today, the foreign exchange market, the forex market, which is basically said foreign exchange is forex, has an estimated turnover of 6.6 trillions a day. So, now you can imagine as of 2019 how big is this. The entire business that is done in this forex market in 1 to 2 days or 3 days is even bigger than the GDP of some of the most popular nations, right. Without the foreign exchange market, international trade and international investment would be just impossible. Companies would have to resort to barter system then. That means, if I am buying, let us say iron ore, and if or I am selling, if the currency would not have been there. So, to buy iron, maybe I have to give something that I had, maybe oil, right. So, if one country would have given oil, the other country would have given iron ore to it. So, this would have happened had this transaction, this foreign exchange market would not have been there. Only barter system, which is this one is the barter system, would have been possible. But barter system obviously is a very old and nearly obsolete system. So, today this international markets, they work only because it is possible due to this foreign exchange market and the feasibility of transferring one currency or exchanging one currency with the other. So, if I need something from Japan, to buy something from Japan, I would need yen. If I need to buy something from Australia, I would need dollars. If I need to buy something from some other country, I would need the host country's currency. So, all these things are possible only because of the forex market. Okay. So, what are the features of this foreign exchange market? First of all, you have to understand this market is a 24-hour market. I have mentioned it. Let us see. The foreign exchange market is a global network of who are the members? The banks, the brokers, the foreign exchange dealers, all connected, even the individual retailers also, the individuals also, by electronic communication systems. So, these people, the banks, the brokers, the banks could be the commercial banks, the central bank of a country, right. So, the brokers may be the the fund agencies and others. the foreign exchange dealers, and so the corporations. So, basically what it says is it is a global network of banks, brokers and foreign exchange dealers connected by a communication system. So, for example, the popular ones are like JP Morgan Chase, Bank of America, Merrill Lynch, Citi, Goldman Sachs, HSBC, Deutsche Bank, Standard Chartered. These are some of the names of the most involved or the most popular participants in the global in the foreign exchange market. So, these people are play a big role, right, and in the transaction, in the entire transaction systems. Foreign exchange market functions 24 hours of the day, different time zones according to different time zones of the globe. So, that means it is one market which never takes rest. So, as you can also you must have heard the Citibank's punchline, which says a bank which never sleeps, Citibank, right. So, no wonder they are correct, because when they work for 24 hours, so there is no time to sleep. If exchange rates quoted in different markets were not essentially the same, there would be an opportunity for arbitrage. Now, what is arbitrage? Very simple for understanding, but has a very high impact. Now, arbitrage is the process of buying a currency low and selling it high. Now, let us take in two different markets A and B, right. So, if we take two markets, for example, A and B. Now, if the dollar price of the euro is 0.99 in New York and 1.01 in Frankfurt, let us say, this would help the arbitrager would buy or purchase the euros at 0.99 here and in New York and immediately resell them in Frankfurt for 1.01, thus realizing a profit of 0.02. So, this phenomena of buying at the same time, maybe at a lesser price, and selling the same item at another market at a higher price is called arbitrage. Arbitrage is taking advantage of the difference of the value in two different markets. Okay. So, the variety of factors that affect exchange rates are like the inflation rate, interest rate, money supply, etc., right. So, these factors affect the exchange rate basically. Okay. So, if you look at the market share of the leading foreign exchange currencies in 2019 by value of turnover, you will get a understanding that no wonder the US dollar leads the race, and it has the highest market share, right. So, it is about 88%, followed by the euro 32%, yen 17%, British pound 13%, Australian dollar 7%, goes in a hierarchy, right, and the last around the Mexican peso is around 2%. So, what it says is basically we have to understand here that the euro and the US dollar, the yen and the pound, these four, they are leading from the front, right, they have the highest market share. In terms of global liquidity and all over the place, by far the most utilized currency is the US dollar, known widely as the world's reserve currency, because every country on the planet keeps large sums of dollars in reserve in order to make hard currency trades on major commodities like oil, gas, grain and gold, which is the commodities basically, right. This advantage is what gives Washington unprecedented power and leverage in international affairs. Most transactions involve US dollars on one side. The US dollar is a vehicle currency. So, what it says basically is, if you look at the amount of use of the US dollar, in fact, many people, many critics, economists, they feel that the entire even the politics behind behind keeping the dollar as a number one currency is there is a large politics behind it, right, and many countries are trying to dismantle the US dollar, but the US has its own interest obviously. So, it works very hard in order to keep the US dollar at the top, right. if the US dollar would not be the most used currency, automatically its business would come down, the business or you can say the importance would fall. So, many countries would not even then use the US dollar for doing their business, and that means the US dollar's importance, if it once comes down, the US economy will be greatly affected, right. So, if you look at the countries like Iran and all, they want the US dollar to come down, but on the other hand the US government works very hard. In fact, there is a lot of if you shadow wars and other things that happen in order to keep the US dollar at the top. Okay. So, as it says, the US dollar is a vehicle currency. So, vehicle currency means it is used for most of the transactions, right. The Bretton Woods agreement established that the central banks would maintain fixed exchange rates between their currencies and the dollar, because that means the dollar is such a powerful currency that almost all the countries, because it is also called as the world's reserve currency, almost all the countries they have to keep some amount of reserves as in form of the dollar, right, because almost all the transactions that you do across the world, all international transactions, they are largely done by through the dollar. Okay. Now, when you come to the participants in the foreign exchange market, when you talk about, as I said, so the banks, for example, JP Morgan Chase, Bank of America, Citi, etc. So, there are large corporations, right, for example, the MNCs and all, who are basically doing the business. So, somebody wants to buy some import something, or even export cars or something, So, whatever. So, the large corporations are there, individuals are also there. So, but they hold a very small value, right, and very small value. Then there are central banks, like for example, we have our RBI in India, right. Every country has a central bank which basically controls the money supply in that particular country. Then you have the hedge funds, investment funds, right. So, there are large agencies, again there are very popular hedge fund agencies also, and these fund agencies also are basically they work to improve their portfolios, right, and there are forex companies. So, these are some of the members, the participants in the foreign exchange market, the forex market. Now, let us see each one of them and try to understand. The first comes the commercial banks. In fact, if you will it is interesting to know that 90% of the transactions in the forex or the foreign exchange market is due to the interbank transactions, happens due to the interbank transactions, right, 90%, right, and less than, or the rest, you can say the rest will be between the banks and the maybe companies, right, or corporations and others, right. So, this interbank is basically the largest or the most significant amount of the transaction that is happening in here. So, what are commercial banks? These banks serve their retail clients, the bank customers, in conducting foreign commerce or making international investment in financial assets that require foreign exchange. So, the commercial banks are those banks who help their customers in conducting foreign or making international investments, right. So, these banks are they are the largest among the largest players who are the most important participants in the forex market. Then you have members like the foreign exchange brokers, central banks, MNCs, individuals and fund managers. So, when you say about the brokers, they operate in the international currency market and act as agents who facilitate trading between the dealers. Unlike the banks, these brokers serve mainly as matchmakers and do not put their own money at risk. So, what are these people basically doing? They are responsible for disseminating the information regarding the value of the currencies, right. So, these brokers are matchmakers who are only disseminating the information across the globe, right, about the value of the currencies. The next is the central bank. As I said, another important player is the central bank of the various countries, right. Now, these banks frequently intervene in the market to maintain the exchange rate of their currencies within a desired range and to smooth fluctuations within that range. Now, if you are following the Economic Times or Financial Express or any good paper or something, or the news at least, then you must be understanding that the central bank or the, for example, the Reserve Bank of India is trying to maintain the exchange rate, right. So, it is trying, it intervenes in the market to maintain the exchange rate. It does not allow the exchange rate to go up tremendously, right. So, within it, it wants to keep it within a desired range, in an optimal range, right. So, that the transactions become necessarily smooth and they there is not much of chaos, right, that develops. So, these central banks are basically they are operating in these markets, they are controlling the other banks also and trying to control the entire the exchange rate, right, of these currencies, and they make a lot of rules also accordingly how you have to manage the exchange rates, the currencies basically, how much you can keep, what are the different, for example, the Indian government has certain rules that how much currencies of different countries you can hold at one point of time. The MNCs are the major non-bank participants. So, these are the corporations basically participants in the forward market as they exchange cash flows associated with their multinational operations. Now, there are two markets, the one is the spot market and the forward market. Now, here we are talking about the forward market for something that you have to pay, right, in the future, and then you have a spot market which you have to pay immediately, right, on the spot. Let us understand that way. So, the MNCs often contract to either pay or receive fixed amounts in foreign currencies at future dates. So, that is what I am saying, in the forward market it is some future date, right. So, they are exposed to foreign currency risk. Now, suppose today I have made a deal and I have to pay the money after some time, maybe, right, after the goods or the the product has reaches me. Now, the time which I am at which I am paying, but that time let us say according to the, because of the change in the currency or volatility of the currencies, I have to pay higher amount than what I would have paid today. So, in such a condition, the players or the corporations who are making business in large amounts, their entire business can be can have a very, it can have a very serious effect on their business just because the currency value has changed. So, today what it is, let us say today it is 71.19, $1 is 71.19 and tomorrow it changes to either 70 or let us say 73. So, in both the cases, one it has come down and the other it has gone up. So, both the cases there will be some effect on these corporations, right, because they are not buying in very small amount, they are buying in bulk amounts, right. In such conditions, this is why they try to always hedge the future cash flows through the interbank forward exchange market. Now, what is hedging? Hedging is basically to try, when the companies try to hedge, means they try to reduce the risk, right, through some mechanisms in connection with this banks, right. So, since the business is a perennial, is a continuous thing that is happening. So, this MNCs, this corporations have to keep in mind all the time the currency situation, if whether it is in their favor or not. So, but if you say, if one thinks in terms of favor or against, then it will be also a very risky proposition. So, in order to reduce this uncertainty, they try to hedge their values, right. Individuals and small businesses are also use foreign exchange market to facilitate execution of commercial or investment transactions. The foreign needs of these players are usually small, only account for a very small fraction of the entire foreign exchange transactions. Here even individuals who are paying an education fee or for remittances, anything that would also be considered, but that is a very small amount. Last is the hedge funds, the wealth funds and the fund managers. They are basically transnational and home countries money managers who may deal in hundreds of millions of dollars, as their portfolios of investment funds are often quite large, right. The major aim of these hedge funds is to make profits and grow their portfolios. So, as we see, the foreign exchange market has 6 important participants, right. The commercial bank, the foreign exchange brokers, the central banks, the MNCs or the corporations, the individuals and small businesses and finally the funds, the fund managers or the fund wealth funds and all this, right, players. So, all these players together make up the foreign exchange market, right. And if I say it is the biggest financial market, as I said, right, and this market has a huge effect on the transaction or the business transactions for any corporation, for any country, anything, right, because the entire businesses that happen among countries, all countries are rooted through this foreign exchange market. So, the entire businesses of different all the countries across the world are rooted through this foreign exchange, because the way to transact can only be done by having the right currency, because today you do not have a barter system. So, in order to have that currency and in order to take advantage of that currency, currency system, one has to be extremely sharp, one has to be extremely careful and has to understand the dynamism of the foreign exchange market, right. So, a very small fluctuation also can have a very large impact just because of the volume of the sheer size of the businesses that are happening, right. Even a point, let us say 0.0001 percentage up or down may result in millions of dollars of loss or gain for corporations and countries, right. So, today we have only started with the foreign exchange market, we have tried to understand it little bit, and in the next session I will take up little, we will try to talk deep into it, we will go deep into it and try to understand what is implications and how it affects the entire international or the business, right. So, thank you very much, have a wonderful day.